Assalamu alaikum, this is Musawwir, an associate cost and management accountant. This is the second video from the course Accounting for Non-Accountants. In our previous video, we had briefly discussed the basic principles of accounting. We had also discussed how the businesses are operated, what are the objectives of business, and what role the stakeholder of a business play in essentially growth of a business. We had also discussed the financial statements and what does the financial statement means and what are the main components of financial statement. Let me very quickly revise the financial statement thing. Financial statements are basically the documents. Financial statements are the consolidated picture of an entire year of a business in the form of some statements which we call financial statements. These statement includes the basic components, 5 main components which make the financial statements. We had talked about the statement of financial position. We also call it as balance sheet. Statement of comprehensive income. Third, statement of changes in owner's equity. Fourth, statements of cash flows or statement of cash flow statements, we call it as well. And the last one is the notes to the accounts or the necessary disclosures to the accounts. So these are the financial statements. Gradually in this video we will be talking about the impact or the effects of the business transactions that a business in an entire year periodically those business transactions having an impact on these financial statements. So in this video we are going to talk about what are the major or what are the possible effects of a business transactions on the financial position or the balance sheet of a company. So in order to understand this, we had numbers as below, like how the introduction of a capital is going to impact the balance sheet. As you already know, balance sheet, the structure of balance sheet is like the basic accounting equation. We talk about the basic accounting equation in our previous video as well. So the accounting equation says total assets in a company are definitely equal to the total liabilities that the company has incurred as well as the capital that has been injected to the business. So the introduction of a capital to a business is going to make an impact. At the one side it's going to add certain amount into the assets of a company. On the other side maybe it is in the form of cash or in the form of any asset that's been employed to the business. The other aspect or the other impact to the accounting equation is that it may increase the capital, the amount of money, the amount of capital that has been invested by the investor. So there are two impacts. One is on the left hand side of the accounting equation, the other is on the right hand side of the accounting equation. That is the one asset increases as well as the capital increases. The other transaction, there's what if we acquire an asset through a check, what we purchase an asset through a bank. If we purchase an asset, the transaction is like we acquire an asset. A single asset is being added to the company, like we have an additional asset, an asset increases. On the other hand, we paid for the purchase of an asset through bank, so our bank decreases. So the impact on the accounting equation is one asset increases, the other asset decreases. You can also see from this balance sheet of the B black over here as well. So when you purchase an asset through bank of rupees $32,000, it's going to add a shop that you have purchased the asset by this amount, and it's going to add the value to the rest of amount. One bank is reduced to 28 because already you have paid 32,000 to acquire the shop. So what if an asset is purchased incurring a liability? The effect to the accounting equation is quite similar because when you acquire an asset, so you add an asset to your total asset bank into your company. At the same time you incur a liability, so you are not going to pay cash at this time because you're acquiring that asset not to pay right away, but to promise to pay in the future time. So at the moment, the impact to the equation is one asset increases, at the same time you have a liability. You have to pay certain amount of that asset in a future time. So we have now the sale of an asset or the disposal of an asset. Usually businesses, when they consume consumables or when they use assets, the non-current assets, by the time they choice or they decide to sell off these assets as well. So what if we choose to sell an asset? What impact does this going to make on your financial position? It's very simple. Like if you sell an asset on credit, so you are basically reducing your asset from your company. For example, you are selling, in this example, you sell goods which cost $600 were sold to J. Brown for the same amount. So you are going to sell a good which costs $600 to Brown. Alright, so the goods amounting to $600 reduces from your balance sheet, as well as this sale is made on credit. So you are not going to receive cash at the moment, but you are going to receive cash in some future time. So this is going to be your account receivable, which is your current asset. So the impact to the accounting equation is one current asset increases in the form of account receivables, the other asset decreases in the form of goods which you are going to sell. So this impact, this transaction is going to make an impact, and it will have a balance sheet like this in this graph. So what we sell an asset on cash and the payment is expected immediately. So if we dispose of an asset on a cash basis, so what happens is you receive cash at the moment. So cash is your current asset. One asset increases, the another asset that you sell, that particular asset, be it a current asset, good, inventory, or any non-current assets, so the asset reduces from your balance sheet, as well as you're receiving cash at the moment. So one asset increases in the form of current asset, cash, other asset decreases in the form of non-current assets, maybe property, plant, equipment, or any current assets, inventory, or any goods or spares, etc. So this is this kind of transaction, like we pay for a liability, right? But liability is usually we owe somebody, a vendor, maybe anybody, a stakeholder, to pay some amount because the transaction has been previously incurred, and you are going to pay because you owe to that particular vendor. So when you pay off a liability, the effect goes to the balance sheet. One asset decreases because you are going to pay in the form of cash either, or in the form of bank. So the bank or the cash decreases from your company because you are going to pay for the liability, as well as the liability because you have paid the liability in the form of cash or in the form of bank. Now the liability decreases. So the impact to the accounting equation is decrease. Left hand side, assets decreases because you pay cash, liability decreases on the right hand side of the equation because you paid off the liability. So the impact will be as follows. So I am not going into detail to make the calculations right here. I just want to make you understand the basic effect of a particular transaction on the financial position. So collection of an asset. Say you had previously sold an asset on credit, so you hadn't received any cash at the time of the transaction, but at the time of the promise that the particular vendor, particular customer has promised to pay in the future time, and at the time of the receipt, when you actually collect the amount of cash against the sales that you had previously made, the impact would be as follows. When you sell an asset on credit, you simply you make an asset addition like account receivable at the time of the transaction, as well as you decrease an asset from your financial position in the form of current assets or any non-current assets. So when you receive cash against that transaction, simply you will add an asset, be it in a cash or a bank. So one asset increases because you receive cash, and the another asset which previously you have accounted for as account receivable, now it decreases because you have actually received the cash. So this transaction is going to settle like this way. So these and certain other transactions which a business usually transacts during the accounting year needed to be treated in the accounting information, like need to be treated as per the rules and the principles of accounting as per the international standards. So how we equate accounting equations? So every transaction must have an impact on your financial statements. So the impact on the financial position, the impact on the balance sheet is to be equated, right? Because whenever you incur any transaction, whenever you transact any nature of the business in your during your accounting year, so the impact to the accounting equation must be equilated. All right, so these have two impacts we have previously discussed, the sales and the purchase amounts. Like here in this table, as you can notice, number of transactions, like if you say effects on the financial statements, like effects on the financial position, you can also add this. I wish I could display you solving the questions right here and display you on the screen, but right here I don't have certain resources to make you display workings of this. So I want you to have these principles memorized verbally. So inshallah we will be discussing in the future videos more detail, and we will be working out, and I will be uploading these drafts or the question banks as well. You can also drop your queries. You can also attach your questions down in the comment box. I will try to respond each and everybody. I also have my email details on my YouTube channel, so you can go there and type to me or write to me anything that you want to be consulted, you want to ask. I will try to respond each and everybody. So this is just a video to make you simply understand the impacts on this. Is for the beginners, of course. So if you have any kind of confusion, you may type to me via email, or you can write down on the comment box. So here you can see these are certain examples of a transaction. What owners pay profit for the year into bank. Owner pays profit for year into the bank. When owners pay profit to the company's bank, of course the effect is like in this side, you can see on the right hand side of my screen. So one asset increases in the form of bank, and the another is the capital or the equity increases because the owner invested the profit, or owner retained the profit into the business. The second point, buy shop or the premises by check. So what happens here, when we buy shop or any kind of asset into business, we basically choose to decrease bank because we have paid through bank. The another is effect is increase asset. One asset decreases because we pay, another asset increases in the form of inventory, shop, premises, or PPE, etc. Buy inventory on credit. Point 3, you can see here. So if you buy inventory on credit, so of course inventory increases, the effect to the financial position is, and we had a liability because we buy that inventory on credit, so we are going to pay that inventory against the inventory in the future time. So it arises the trade payable, so we have liability over here. Sale of inventory on credit. Similarly, if we sell inventory on credit, so one asset, of course, inventory decreases because we sell it out. The another asset, which is trade receivable, is increases because we do not receive cash at the time of transaction, but we will be receiving cash in future time. So this is the account receivable, or we call trade receivable. Number 5, sale of inventory for cash or bank. When we sell inventory, so of course the asset decreases because it's going out, and we have another assets coming in, that's the bank or cash. The other point, the 6th point, is the pay creditors. Creditors are those whom we owe, like we have to pay for the creditors. Like creditors may be our suppliers, creditors may be our any related party that we are doing business with them. So we need to pay the creditors because we owe to them. So when we pay them, we the impact or the effect to the financial position is we choose to decrease the bank because we are going to pay from the bank. The another thing happens over here is we it decreases the liability because previously we had purchased something from them and we promised them to pay in the future time, and now we are going to pay them. So the trade payable decreases over here. This is the nature of trade payable is a liability, a current liability, so it decreases. Debtors pays money owing by check. Of course, debtors are our customers, and debtors are those that a company expect to receive or collect cash. So they may be customers. Debtors may be any kind of nature of a business that they are doing business with a company, so they owe to the company. So when debtors pay money by check, it happens like we have a bank increases because they paid through bank. The another impact is decreasing the trade receivables because when they pay the trade receivables previously we have booked into your accounts, we decrease them because these trade receivables are now received and they are no more to be displayed on the financial position. The another example, owners takes money out of business bank account for use for personal use. What happens when owners takes money out from the business? It's basically we call it withdrawal as well, because they choose to reduce the amount of capital into the business because they are making this withdrawal for their personal use. What happens to the business is the bank decreases because they have withdrawn a particular amount of money from their share, from their amount in the from the share capital. The another impact is the capital decreases or the equity decreases because they have taken money out for their personal use. Owners pays creditors from private money outside from the firm. Of course, it's not necessary that owners pay cash into the business or owners inject money to the business. Sometimes owners directly pay off the creditors. So when the owners directly pay off the creditors outside from the money from outside the company, the liability is of course going to be reduced, as well as there increases the equity because owner has paid off the liability. So the company is not going to pay any money now because the liability reduces. Now the amount of capital increases because the investor or the owner has paid off the liability. So these 9 transactions and these causes are the total cases that we may have some significant impact on the financial position. So there may be so many kind of transactions that on a daily basis a company observe. So those all transactions must have an impact to the financial position. So this video was about what is the impact of accounting transactions, what is the impact of business transactions on the financial position. If you have any kind of query, any kind of question regarding this topic, do not hesitate to write it down into the comment box or write to me on my email, which is displayed on my channel as well. So you will be answered very shortly, inshallah. I hope you like this thing. If you have any suggestions, please do not hesitate to write to me as well. Thank you for watching my videos. I hope you enjoyed this and you would subscribe to my channel. Thank you.